you and I cook the equity food in-house. We tend to create our own equity allocations within Gebhardt Group, but when it comes to fixed income, let me be impossible to misunderstand. You and I do not do that in-house, whether we're buying individual bonds or whether we are placing assets inside of bond ETFs and mutual funds.
We partner with the best of the best.
We partner with the best. There's so much complexity there. So I just want to make sure we're clear on that. Did you know that I have 3 really complicated relationships in my life?
With me, myself, and I?
Close. My relationship with money, my relationship with people, and my relationship with self. And they're all connected together because when my relationship with money got out of whack, it totally had an impact on those other relationships. That, my friend, is what we call having financial sobriety.
So who are you?
I'm Matthew Grishman. Who are you?
Jim Gebhardt.
And we're a couple of financial advisors trying to have an untraditional conversation about our favorite topic, money.
Let's go.
Hey, tribe. Welcome back for part 2 on bonds. I am so grateful Ace had us push the pause button. You're probably starting to figure out, if you haven't already, that when Jim and I get excited, we could talk to a wrong number for 3 days. The opportunity in the bond market is something we haven't seen in nearly 20 years. And the opportunity for the right person is unlike anything we've seen in a long time. So we're super excited. We're glad you've had this opportunity to digest the first part of Our Bonds Are Back. Let's get going with part 2. Here we go.
So this concept of, you know what, I'm just going to, I like it. It's very comfortable to stay in my money market fund.
Sure.
Well, guess what? It's going to go down in terms of the interest that it's going to pay.
Right.
Unless you do something to lock in interest rates where they are right now.
Sure.
So that is a consideration in terms of looking at alternatives to money market that could take little risk and provide you with a locked-in interest rate.
I guess then it probably makes sense. And look, we've got to be very careful. Nothing that we are doing here today is about any specific advice. You know, we're not suggesting that any one person take the money they have in money market and buy a specific security with it. You really need to work one-on-one with a financial advisor to figure out if that's right for you.
Right.
This is just some kind of general
education.
Yeah, general education as to if our friends at PIMCO are right and the Fed reduces interest rates 3 times this year, there is an appreciation opportunity in the longer interest rate environment, meaning stuff that goes out further than money market, right? Money markets are generally funds that are comprised
maturities.
Of very short-term commercial, like overnight kind of one-day loans to 30-day loans. But then there are these things called taxable bonds and tax-free bonds that if you're willing to loan your money out for a longer period of time, you can get paid ideally a higher interest rate for it, but there are risks that come with that.
Yes.
Right? So, let's talk a little bit about taxable bonds. There are lots of different types of these. There, I think, are 3 that we should maybe mention. Treasuries.
Yeah.
You know what those are?
I do.
How about agencies, or what are known as asset-backed securities?
100%.
You know what those? You remember those too?
I do.
I mean, because given the interest rate environment and how hot real estate's been, I want to make sure you remember these as well.
we gotta
Dust it off?
Dust these things off every once in a while.
I'm so grateful we could do that in Newport Beach. That's a great place to go to
better
school.
Than Fargo.
And then, this time of year,
all those
it sure
conferences we don't go to in Fargo.
Right. Thank heavens that all the bond people like sunshine. And then, of course, there's this third category of taxable bonds, which feels like the most opportunity potentially is with the corporates and what they call high yield bonds.
Right. And just a point of clarification on the treasuries is there is some tax advantage to those. Those are taxed at the state level, not the federal level.
They're tax-free at the state level.
Tax-free at the state level.
Well, how lovely is that?
That's a little bonus.
So if we loan our money to the federal government, the interest that they pay us on that loan is only taxable
at the state in which you live.
So they're federally tax-free.
Yeah, so if you live in the state of confusion like we do,
right,
you're going to be taxed on that piece.
So here in California, that's 12.4%?
If you're all the way uppity up there.
Oh, well, who isn't?
Right.
Okay. Well,
so those, just in terms of a category, taxable bonds are going to pay a generally higher rate of interest because of the fact that there's going to be a tax component to that.
So those are generally higher interest than tax-free bonds.
Yes, which we're going to get into the reasons why in tax-free bonds in a moment.
Why?
But
so I got can I throw a question out? Can we start with treasuries, or did you? Well,
I'm not a fan.
I know, and one thing I've always learned about treasuries, and remember, I used to work for that company on the East Coast called Lord Abbett, which probably next to PIMCO, one of the smartest bond people on planet Earth. So I got
Lord
the
Abbott
benefit.
Bond Debenture.
I got a lot of benefit of learning a lot about bonds through their wonderful those wonderful people. And one of the things I was taught is that some of the most highly interest rate sensitive bonds on planet Earth are long-term treasuries. So if we see 3 potential rate cuts coming, wouldn't it behoove me to own some treasuries being super interest rate sensitive if rates come down, and like a seesaw or a teeter-totter, depending on what part of the country you're from, as interest rates come down and prices rise, if treasuries are some of the most interest rate sensitive, why wouldn't we want a couple of those in the portfolio?
I think we have an environment with U.S. treasuries that is challenging.
Okay.
Number one, the Fed is selling them as they can. They're no longer buying them to bolster the bond market.
Oh, that's right. With the whole tightening.
We got a tightening of the Fed's balance sheet, which creates headwind.
You explained that well in episode 70. No, episode 80, I think we talk about that.
Terrific. Rinse and repeat. I'll pause.
Love it.
For station identification so we can insert a quip there. Anyway.
With the Fed unloading them, you don't like that.
I don't like that. I also don't like the issue on... granted, the United States remains the cleanest shirt in a dirty pile of laundry.
Of course.
Globally, in terms of government-backed securities, like treasuries.
Mm-hmm.
However,
so
I'm a little anxious on the credit quality and the debt that we take on and the countries around the world that, have been lightening in their own purchases of government U.S. treasuries. So
here's what I take from that.
I like my options.
Here's what I take from that. So the teeter-totter of interest rates going down and prices going up, what I just heard you say is that if the Federal Reserve Bank, which at one point was the largest buyer of U.S. Treasury bonds, is now selling Treasury bonds.
Yes, that's headwind.
You now have headwind because of this concept of supply and demand, right? If there's an oversupply of Treasury bonds in the marketplace, despite interest rates coming down, the fact that there isn't as much demand could hamper price appreciation. That's what I'm getting from you.
Who is the very entertaining commentator on CNBC who does all the Treasury talk?
Oh, I don't know. The only one I remember is Kramer. I don't watch CNBC very much.
I can't believe I'm blanking on his name.
Treasury Watch.
Treasuries is like watching paint dry.
Ugh.
And this guy, for 25, if not 30 years, has made Treasury issuance an art form in terms of an entertaining to watch. And if you listen to him,
Ace, Google time
at all, it's been a little light. It's not it's not been the greatest. It's another throw out to Jill. It's been good, not great.
Right.
And thanks to our Cracker Jack research team, it's Rick Santilli.
Oh, okay.
Yeah, Rick Santilli.
I remember him.
Has made treasuries on CNBC one of the most entertaining little quips that they do, which again is next to paint drying.
Talk about turning a Pinto into a Ferrari.
Right.
Good for Rick.
So I like other options on the menu. And again, are you the going long end of the curve on treasuries?
You mean like 30 years long?
Are we looking for the income, or are we really speculating on the appropriation opportunity?
Well, that's a great rhetorical question.
An advanced level class.
And that's a rhetorical question we'll leave out there. So go ahead.
But what I want to reiterate over and over is the simple inverse relationship between interest rates and bond prices.
The teeter-totter.
the teeter-totter.
The seesaw.
When interest rates come down, bond prices are going to go up.
Generally.
Yes. So where the appreciation opportunity can come is from owning the bonds today. Interest rates come down. The price of your bond, think of it like the price of your house. Think of it like the price of your stocks. Your bond price went up. And that's where the appreciation comes from. And you'll hear bond managers and sophisticated bond people talk about total return.
Sure.
Right? A total return bond fund. What does that mean? Well,
what does that mean, Jim?
That means it's a combination of both the income you're going to receive and ideally over a long period of time, appreciation in the value of the bonds. Well, that's been very hard to do in the environment in which we've been in. But now that rates have come up,
it's an opportunity again. And let's again, for those that are with us today, this is
and still with us,
and
that
still
we
with us.
Put them to sleep.
Well, you either shut us off or you're still with us because you're curious to become educated like you and I were in Newport Beach. What drives that price appreciation? Think about this for a minute. If you've benefited from an increase in interest rates, so now you own a bond, right? You loaned your money to GE. They're paying you 7%, which is probably not too far off from what's out there these days, right? You could probably get a higher coupon corporate bond in the 6 or 7% range. So if GE is borrowing your money and paying you 6% a year, and all of a sudden interest rates drop, the Fed cuts rates, and now GE is able to offer bonds and borrow money at a lower interest cost, say 4 or 5%. What does that do to your 6% bond if you want to go out and sell it to other people?
The price went up.
Sure, because if all I can buy is 4 and 5 on the new issue market,
you got a 6 or a 7,
but you're holding on to a 6, that makes your bond more valuable.
So if you sell it, that's where the total return would come from.
Bingo.
Yeah.
Bingo.
Okay.
All right. So if treasuries, I appreciate your point. We're going to come back to corporates in a minute. I appreciate your point on treasuries. I think a good alternative we could talk about, if that's not necessarily exciting for you, is this idea of agency bonds, which they're almost as secure as treasuries because they have occasionally a little bit of government backing.
A lot of government backing.
Yeah, I mean, you know these things called Ginnie Maes and Fannie Maes and Freddie Macs.
Mortgage-backed security.
Yeah, that's one form.
And what is it? What is the back part of the mortgage-backed securities?
Well, first there's the mortgage part. Right. The mortgage part is interesting because banks are no longer retaining their own risk. Right. Banks don't want to be in the risk business anymore. A lot of that has accelerated since what were those couple of places, Silicon Valley Bank and First Republic, and some of those guys went belly up. So since that, there has been this acceleration. Like more of these types of bonds have been issued in the last year than like since the 1990s, which blew me away to see the numbers of new kind of agency bonds that are being issued.
And so when the supply goes up and the demand is meh,
prices go down.
Right. And so the prices on these things are some of the lowest our friends at PIMCO have seen since Methuselah.
Exactly. In a long time. So the way banks get these mortgages off their books is they package them.
What does that mean?
So when a bank loans,
they put them like in one of those Amazon Prime boxes?
Yeah, they do. And then you can go ahead and buy them in the form of a mortgage-backed security.
Oh.
No. What they do is they hire underwriters, they hire firms to take these mortgages off their books and package them into these what's called securitized loans that they can then go out and sell to the public. Because what's behind those mortgages is the income that you and I are paying our mortgage.
Yes.
And that passes through now from the bank to the new bond owner.
Yes.
And they are lovely, lovely little packages of mortgages that are backed mostly by the U.S. government.
Right. As a subsect of the bond market.
Yes.
Our PIMCO friends were pretty excited about this particular slice of the market because the prices of these things are very low.
Yes.
There is less risk than, let's say, corporate bonds.
Sure. There's still risk, but less risk.
And if rates come down, you'll see some appreciation as well. So you're buying something. Let me see if I
on sale.
If I like this. I walk into my favorite store and it's on sale, and then 90 days or 180 days later, I can turn around and sell them and they went up, I think I'd want some of that.
Sure. We're going to promote long-term investing, though, my friend.
Okay, sure.
Investing in bonds is long-term, and do your due diligence and talk to your financial advisor if you have any questions.
Yes.
All right. So
Corporate bonds?
Well, what I appreciate
Please?
is we've talked a little bit about corporate bonds already. There are two ways for corporations to raise money when they want to expand their business.
Yeah, we did that already.
Right? We did that already. So what's the opportunity you see in the corporate bond market?
Well, the fact that as interest rates come down, there's going to be more interest. Companies are going to be, there's the issuance rate of corporate bonds.
They're going to want to loan more money.
They're going to want to loan more money as interest rates come down. So using some of the smart people out there, that's not something you and I are going to do, which we're going to talk more about that. We're not going to go pick individual corporate bonds. I want, as I know you do, there's a bond manager at PIMCO that we met who couldn't be more center of the bullseye in the West Gebhardt School of Relationships. This guy has logged 3 million miles on American Airlines, sitting with CEOs of publicly traded companies to look in their eyeballs and smell them out.
Yep.
And that's my guy. Guy's name is Mark Kiesel. He's one of the chief investment officers at PIMCO, and that's how I do business.
Yep.
That's how you and I do business. We like to sit across the table, break bread.
Oh, yeah.
Use all of our senses to know whether somebody is blowing smoke up the
hoo-ha.
The hoo-ha.
Yeah.
I love that.
Well,
you and I are not going to go pick through some inventory list at our custodian, which is Charles Schwab, and pick individual corporate bonds.
Right.
This is a specialty. In the same way that you go to a particular medical specialist,
Sure.
I personally, with my money and as a fiduciary, would do the same.
And part of the reason why you and I do that is because when you just look at the size and scope of the bond market relative to the stock market, right? I mean, the stock market's pretty big. There's something like, 2,500 publicly traded companies?
Actually,
what's the number? You told me this. We just did this.
And I fact-checked myself.
Okay. How many publicly traded companies?
I don't know.
Oh.
The size of the bond market and the size of the stock market are the same.
Oh, they are?
They are both plus or minus $50 trillion.
I thought the bond market was bigger.
I did too, and I was wrong.
Huh.
They're both about the same. The value of equities in the United States is like $50 trillion, and the value of bonds in the United States is like $50 trillion. Not government debt, just the U.S. bond market.
I was thinking, okay, in value, I get that. I was thinking more in terms of issuance.
Oh, I have no idea.
The number of sticks out in the game.
No clue.
That, my understanding, is the bond market is 10 times the size of the stock market.
I've always heard that as well.
Yeah.
We would have to fact check that somehow.
One thing we do know is that it's a hell of a lot more complicated. One of my favorite things that happened when you and I were down in Newport Beach was a question came right over my right shoulder in the arena. And somebody asked, I don't remember if it was Jerome, who they asked, but they asked, hey, when is PIMCO going to really build out the equity side of the shop?
I love this.
Oh, the answer was priceless. Why would you want that? Why would you want another mediocre equity manager? Don't we have enough of those already? We are the very best in the world at something, and we're going to stick to that. Thank you very much.
It's like asking a world-renowned orthopedic surgeon.
Right.
You want to be a gynecologist?
Exactly. Why not?
I mean, you could. I mean, a doctor's a doctor,
right?
Or how about a pediatrician? You love kids.
Well,
it's not their knitting. They want to stick to their knitting. They're world class at what they do. The show is not sponsored by PIMCO. It's just we like to surround ourselves.
Yeah, we receive nothing from them for talking about them, and they receive nothing from us for talking about them, other than maybe a few of our tribe actually doing some Googling and learning about them a little more because they're that good.
But we like to surround ourselves
with the best.
With the best and the brightest, and our experience with these folks is that is the case.
Yes. All right, let's spend a couple of minutes, because there's a segment of corporate bonds that I think get its own little unique asterisk because they tend not to be as interest rate sensitive as the rest of their peer group, right? If we're looking at really good quality corporate bonds that are rated BBB or higher, that's what we would call investment grade corporate bonds. Those are the bonds that are going to react more to fluctuations in interest rates. There's a subset of triple B minus or lower, so not the greatest credit score, what they call high yield bonds that are going to pay you. Like if you don't have good credit,
you pay a higher.
And you want to go buy a car.
Yeah.
You're going to pay a higher interest for that loan.
Right.
Well,
because of your credit score.
Correct. There are companies that don't have exactly as good a credit. So if they're going to borrow money, they have to pay higher interest. So don't just jump, my suggestion, don't just jump at that high interest rate and buy it without being aware of the risk that comes with owning those types of bonds. And also go into this environment with your eyes wide open that although you might expect some price appreciation from owning those bonds as interest rates come down, generally those bonds and their prices are going to improve when the individual company itself is experiencing upgrades to its credit score. So as the
100%.
As the company gets healthier, right? So the opportunity with a high yield bond to find price appreciation is to either do this yourself or hire a good bond person to do this for you, is to do some homework on trying to identify a company that has improving fundamentals, improving credit score baked into what could be happening in the future, and then you could see some price appreciation.
And in the context of one of our favorite subjects, in nothing to do with the bond market, but in this concept of who, not how. In the world of who, not how, I'm going to take my hard-earned money with a team of people that have, I don't know, plus or minus 1,000 research analysts to go pick apart all that, because that's what they eat, breathe, sleep, and do.
You and I cook the equity food in-house. We tend to create our own equity allocations within Gebhardt Group, but when it comes to fixed income, let me be impossible to misunderstand. You and I do not do that in-house, whether we're buying individual bonds or whether we are placing assets inside of bond ETFs and mutual funds.
We partner with the best of the best.
We partner with the best. There's so much complexity there. So I just want to make sure we're clear on that. Can we shift to my favorite thing to talk about?
Your favorite thing to talk about? Really?
One of my favorite things to talk about. Come on. There's always a little hyperbole in this kid's mouth. Tax-free. I love tax-free.
Is that your Jim Gaffigan?
No, that's my Matthew Grishman whispering, but
nice.
It could be somebody else, but why would I want it to be anybody else but myself?
Because he's very entertaining.
He is. I'm trying only in vain to be as entertaining as Jim Gaffigan.
So tax-free is very attractive.
Oh, I liked tax-free bonds 10 years ago.
I haven't even said the sentence tax-free municipal bonds in 15 years until now. Last year.
Now, Jill would tell you that's not a complete sentence.
I know it wasn't a sentence, but
you didn't have proper sentence structure with a noun, a verb,
very true.
Conjugate. Yeah.
Sure.
Okay.
I hereby resign.
Well, what is the difference between the taxable bonds we were just talking about and a tax-free municipal bond?
Tax-free municipal bond has in the title the very definition of the item. There is a tax-free aspect of the bond. So
issued by municipalities.
These are issued by municipalities.
State and local governments, right?
State and local governments. And they have the benefit of being federally tax exempt. And then if it's issued in your home state of residency, it is most likely tax exempt at the state level.
So if you live outside of Las Vegas, Nevada, and you loan the city of Las Vegas a whole bunch of money to build the Oakland A's a new stadium, and they pay you interest to borrow that money, you're not going to pay any taxes on that interest.
Correct. Particularly in the state of Nevada that has no state income tax.
Lovely.
Right? So in the state of California, where we do have taxes and we have one of the highest income tax rates in the country.
Right. What would happen if I wanted to buy that bond living in the state of California that was issued by the city of Las Vegas?
So there's no, and certainly you would want to verify all of this with your CPA depending on your circumstances. We are not CPAs. There's our compliance disclaimer, but there is no.
Thank heavens we don't give tax advice.
Right?
That is a complicated beast.
So you would have no federal tax on that bond, but you would have state income tax on that bond.
So California would want its pound of flesh.
California wants its pound of flesh, and there's a school of thought. I mean, and this is, if you like tax-free bonds, then you're really going to like double tax-free bonds.
Oh, I love it.
Right?
And if you live in New York City, you're going to love triple tax-free bonds.
Exactly. So that just goes to where you live, right? So if you live in New York City and you buy paper that's issued in New York City, it is both federally, state, and any local tax that may apply, which is kind of unique to New York City.
Yeah, they charge 1 to 2% local tax
for
if you
the
live
privilege.
in New York City.
Yeah. California, a double tax-free bond would be if you're buying a municipal bond issued in the state of California, that both your federal and California tax are exempt.
How are those bonds, those loans? So a city in California, one of the state agencies, they want to raise money for a project. They want to raise money because they want to raise money because that's what we do in California.
Yeah.
So they're going to go issue a bond. They're going to borrow money from you and me, and they're going to pay us interest. How is that interest relative to the stuff we were talking about in the taxable market?
Well, the interest itself is generally going to be lower than the taxable market. But I also want to pick apart, there's two different kinds of bonds that can be issued. There are revenue bonds and there are general obligation bonds. General obligation bonds take a little bit more risk to the investor in the state that it is simply backed by the credit worthiness of the state itself.
Yeah, but generally those are insured, right?
Not always.
Okay.
You certainly can.
Yeah.
Right? You buy uninsured ones, they're going to pay you a little bit more than the insured ones will.
Sure.
A revenue bond is backed by the revenue that's coming from, let's say, the toll or a tax that is being applied to the residents for that project. And so that's collecting revenue that is paying down.
So it's a project that will create revenue.
That's
like
going to
a
pay
toll,
down,
like a stadium.
pay down the balance of the loan, which in super simplistic ways is less risk than being a general revenue bond backed by the state.
Sure. That makes sense.
So in the context of why do you want to own these, let's say you have very high income, and we're going to generalize this we're going to simplify this as best we can. If you're buying a piece of paper that is both state and federally tax exempt.
And by piece of paper, you mean a bond.
A bond, sorry.
Yes, that's okay. I got your jargon.
And it's paying 4%.
Sure.
The taxable equivalent yield on this is going to feel like 7% to you.
Blah, 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 blah.
Right.
So
because of the fact that you're not paying tax in the state level or the federal level, that 4%, when you figure out what it's equivalent to if I had to buy a bond, a corporate bond, a taxable bond that would pay me the same amount, it's going to be probably north of 7%.
So if I bought a corporate bond that's paying me 7% and that 7% is taxable, my after-tax return on that would be the equivalent of buying a 4% tax-free bond.
If you're in very high tax brackets.
If you're the highest tax
Right.
bracket. Okay.
So generally the person that is interested in tax-exempt bonds, municipal bonds, is someone that's in a very high tax bracket.
Yeah. And I would say, based on that high tax bracket, I don't know of any corporate bonds right now paying north of 7%.
No, and you got to look to find 4% munis as well.
Yeah, they're there.
But we have portfolios with clients that are in the 3.5% range.
Yeah.
And where this is attractive is we went back earlier in this mega part series that we're doing here today. We talked about manufactured income.
Yep.
Right? Well, our clients that own munis are building these portfolios in two ways. One, they save money and they add it to their munis. The other way is they just plow the interest that they're receiving from these munis back into the portfolio to buy more munis.
Right. Reinvesting.
This becomes one of the legs in which they'll stand on in retirement with tax-free income.
Yep.
And sure, they'll have their Social Security. Maybe they have other manufactured forms of income that we've been using over the last 15 years. But now this new generation of investors has a wonderful opportunity to be able to lock in some of these yields where they are today.
Yeah.
And build guaranteed lifetime income.
There's nothing more fun than sitting down with a client and offering them more options. To be able to sit down and look at deploying $1 million, $2 million, $3 million into some sort of asset that's going to create passive income. And to sit down now and be able to have something to compare to a real estate investment, different types of cash flow producing options. To sit down and look at what would be the net after-tax cash flow of a real estate investment
Well,
plus all the risks that come with it.
Yeah, and the real estate guys would tell you that, it's not even a conversation. Okay.
Of course
I
not.
get it. They got a little bias.
Right. Whereas you and I as fiduciaries really don't. It's, we want to sit down and offer options to clients, show them their different options, and then help them feel capable of making a good decision, right? When we can sit down now because interest rates are up and show them different options of how to create income in multiple ways, it's so much more fun of a conversation. And especially when something like tax-free bonds can simplify the conversation, because we're not dealing with tenants moving in and out. We're not dealing with regulatory changes. We're not dealing with having to repaint and carpet the damn thing or when the roof needs replacing, right? You know the cost of your investment up front. You know your cost basis up front. There's no additional complexity.
And it's truly passive in the concept of you just wait for the coupon, right?
Oh.
You just wait for the interest to hit the old bank account.
Well, you and I have talked a little bit about this throughout the show, and I think we can't reinforce this enough. This is an area that all we're trying to do today is just create some awareness, create some education around the fact that
elevate the conversation that isn't happening anywhere because it's all about the GD election.
Right. Exactly. This is an asset class. The bond market is an asset class that even when interest rates were more exciting, was always thought of as the snoozer, risk-off trade, where when I didn't want to be exposed to stocks, I'd buy bonds to be less risky, or my grandpa would buy bonds to, create some interest. And now we've got an option where there are some pretty smart people who see the risk profile in bonds as having a bigger upside potential now than even the stock market.
Partly because the price of the stock market, right?
It's at all-time highs.
We're sitting near all-time highs in a lot of different ways.
Yes.
So if we're looking at things on a relative basis, they brought some analysis forward in our meetings last week that said that over the next several years that the returns in bonds may actually be better in stocks.
May, right? Potentially.
May, absolutely.
So it's something to make people aware of. It's also something that we can't hammer this point enough. This requires the help of professionals. Unless you are a bond investor, a professional bond investor, like you're employed by a PIMCO, a Lord Abbott, a JP Morgan, one of these firms.
Fidelity.
Yeah. This is a very complicated market to try to go out there and do on your own.
Yeah.
Whether you are investing for what's called total return, thank you for defining total return, where we're combining the income we receive through those interest payments plus the appreciation of the bonds, or you're like my dad, Hank, who loves his municipal bond portfolio for the tax-free income it's providing for he and my mom now and into their retirement. The idea of hiring professionals to help you either with the active management of creating total return or the passive idea of laddering municipal bonds for income requires the hands and the touch and the eyes and the brain and the collaboration of professionals.
Yeah, I mean, just some of the articles that you and I read on this stuff, right? That's one of the things that we do. You were sharing an article with me that was looking at portfolio managers, one of whom we met at PIMCO, a guy by the name of Jerome Schneider, and then two other managers, one at JP Morgan and Fidelity. And the Fidelity guy was quoted as saying, hey, look, I've been managing bonds for 34 years. I've got a tremendous amount of experience. But in the last 3 years, we've had a pandemic, we've had 9% inflation, and $5 trillion worth of stimulus. Three things in my 34 years
I've never seen
before.
Yeah.
And Jerome, in our session with him last week, talked about we live in a world with maximum uncertainty. And
you love that phrase.
I do. I can't unthink that phrase because now it's in my head.
Yeah.
And what have we been talking about? What is everybody talking about in 2024? Is there anything else to talk about in 2024?
Other than maximum uncertainty.
Thank you.
Right.
Nice. You picked up. So in a world that has maximum uncertainty, I like the fact of predictability. This is something in the world of investing that is, with the right professionals behind you, can be a simple source of passive income with pros that are navigating this thing, and I get excited about that.
You and I, we learned a lot when we were in Newport Beach. We learned about convexity and dispersion and bifurcation, but my favorite was maximum uncertainty, by far.
It's got to be the theme of 2024.
I'm so grateful that entrepreneurs have options that we didn't have just a few years ago. Bonds are back, baby.
Yeah, they're back, and we've talked a lot on the show and with our clients about avoiding bonds before the mess with the Fed.
Uh-huh.
But as that storm has passed, there's opportunity.
Yes.
And if you have a financial advisor, go sit down and talk with them about bonds. If you don't have a financial advisor, I don't know. Either go find one or
call us.
Or call us at 877-283-9150.
It might be good for us to sit and talk, or if it's not, we know lots of people that we could introduce you to go sit and talk.
Exactly, because this is an opportunity that we haven't seen in 15 years. And depending on your circumstance, there's opportunity. The thing that I get excited about is that it's opportunity without having to take necessarily very much risk.
Yeah.
Right? If you're going to buy stocks, there's risk. If you're going to buy real estate, there's risk. If you're going to buy commodities, there's risk. And I'm not saying that bonds are risk-free by any means, but I'm saying the environment that we're in now has them in a much lower risk category than they've been in a long time.
With some reward potential that they haven't had in a very long time.
Yeah.
What's the toll-free number again?
877-283-9150.
Or if the phone's a heavy object for you like it is for me and you prefer a little bit of typing and email, fire us an email. Matthew@yourfinancialsobriety.com. Jim@yourfinancialsobriety.com. We would love to sit and talk bonds. And with that, my friend,
that's a wrap.
If you like what you heard, leave us a review and be sure to subscribe. And check out our website, yourfinancialsobriety.com. Thanks again for listening today. Here to help you find more clarity, confidence, and capability along your journey into financial sobriety. I'm Matthew Grishman.
And I'm Jim Gebhardt.
Be intentional with your money.
Jim Gebhardt is a registered representative of and securities offered through Brokers International Financial Services, LLC, member SIPC. Jim Gebhardt and Matthew Grishman are investment advisor representatives of Gebhardt Group Incorporated, a registered investment advisor. Brokers International Financial Services, LLC, and Gebhardt Group Incorporated are not affiliated. The opinions in this podcast are for informational purposes only and are not intended to provide specific advice or investment recommendations. To determine which investments or financial advice may be appropriate for you, consult a financial advisor prior to investing. Any reference to market performance is based on historical information, and there is no expressed or implied guarantee of future performance. Opinions expressed on this program do not necessarily reflect those of Brokers International Financial Services, LLC. The topics discussed and opinions given are not intended to address the specific needs of any listener. Gebhardt Group Incorporated does not offer legal or tax advice. Listeners are encouraged to discuss their financial needs with the appropriate professional regarding your individual circumstance.
Fixed income securities are subject to increased loss of principal during periods of rising interest rates. Fixed income investments are subject to various other risks, including changes in credit quality, liquidity, prepayments, and other factors. REIT risks include changes in real estate values and property taxes, interest rates, cash flow of underlying real estate assets, supply and demand, and the management skill and creditworthiness of the issuer. There are material risks associated with investing in DST properties and real estate securities, including liquidity, tenant vacancies, general market conditions and competition, lack of operating history, interest rate risks, the risk of new supply coming to market and softening rental rates, general risks of owning, operating commercial and multifamily properties, short-term leases associated with multifamily properties, financing risks, potential adverse tax consequences, general economic risks, development risks, long hold periods, and potential loss of the entire investment principal. Past performance is not a guarantee of future results. Potential cash flow returns and appreciation are not guaranteed. Active portfolio management, including market timing, can subject longer-term investors to potentially higher fees and can have a negative effect on the long-term performance due to the transaction costs of the short-term trading. In addition, There may be potential tax consequences from these strategies. Active portfolio management and market timing may be unsuitable for some investors depending on their specific investment objectives and financial position. Active portfolio management does not guarantee a profit or protect against a loss in a declining market. Mutual funds and exchange-traded funds, ETFs, are sold by prospectus. Please consider the investment objectives, risks, charges, and expenses carefully before investing. The prospectus, which contains this and other information about the investment company, can be obtained from the fund company or your financial professional. Be sure to read the prospectus carefully before deciding whether to invest.